Hi guys, so this is the next video in the chapter 8 series. So today we'll be looking into principles of insurance. So in order to maintain the insurance business, the principles of insurance should be followed. The principles of insurance are insurable interest, utmost good faith, indemnity, subrogation, contribution, proximate cause. Now let's look into them individually. Insurable interest. This is basically where there is interest over anything, whereby when there is existence, then there is a economic advantage, and loss of it would create an economic disadvantage. Example, so there is a definite insurable interest in the life of the husband for the wife and vice versa. Legal owner of any property has interest over their property. Creditor has an insurable interest over the debtor for the limit of the amount they have lended. Utmost good faith. This is to reveal all information related to the insurance agreement by the insurer and the insured related to the subject that is under insurance. Indemnity. When there is an insured item that is damaged, then an adequate amount of compensation to restore the item is known as indemnity. The amount would be compensated up to the damage cost and a maximum for up until the insured amount. If the item insured is a car and worth 8 million and is insured for 8 million, but the damage that is caused is for 2 million, then only 2 million would be compensated. Subrogation. This is where the insurance company steps into the shoes of the customer in order to claim the necessary damages from the third party. The insurance company, during an accident of a property or vehicle, after the compensation to the customer, will be able to collect the debris, that is the remains. Contribution. Basically, if an item is insured in several insurance companies and there is a damage, then compensation payment will be proportionately provided by each insurance company. So if the item insured is a property and is valued 10 lakhs and has been insured for 5 lakh in company A, 3 lakh in company B and 2 lakh in company C. Imagine there is a damage that is occurred to the property worth 1 lakh. Now each insurance company has the capability of paying out the 1 lakh, but they would not pay that. Rather, what would happen is each company would proportionately pay the damage. That is, the company A would provide 50k, company B would provide 30k, and company C would provide 20k. Because by insurance, you can't make a profit. Rather, you get compensated for the loss made up to the insured amount. Proximate reason. There could be multiple reasons that could have caused the damage of an insured item or life. The payment would only be made if the reason is covered by the policy. If the policy states that theft is not covered for the insurance obtained for the house and the house gets robbed, then the insurance will not compensate them. In terms of life insurance, insurance interest, utmost good faith, and proximate reasons are the only principles that are relevant. The reason is that the loss is immeasurable when a loss or an accident happens to a person. Hence, the value mentioned in the policy will be granted as compensation for life-related damages. An important point to note is that insurance company sometimes insure the risks that they have undertaken to another insurance company, and this is called as reinsurance. Since the insurance company transfers their risks to another insurance company, the premium charged to the customers are relatively low. Apart from that, there is something known as underwriting, where if the insured item is of high value, then several insurance companies divides the risk. And when there is an issue which leads to a compensation, then these insurance companies would compensate up to the amount they have undertaken. So that's it with this video guys. Please do like and share to learn and let others learn. Thank you.
Created using Powtoon.